You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, I'd like to discuss the market circuit breakers and how they impact the options market. In 2013, the SEC implemented a new market-wide circuit breaker rule for U.S. equity, options, and futures exchanges in the event of a severe market price decline. Using the broader S&P 500 index versus the narrower Dow Jones Industrial Average, which was used in the past, trading halt circuit breakers now kick in with 7, 13, and 20% downward moves from the prior day closing price. If the S&P 500 falls 7% from the prior close, the markets halt trading for 15 minutes. Of course, as soon as the underlying stocks are halted, all option trading stops as well. I'm sure most or all of you know options can't trade without the underlying trading. Now, the next halt occurs with a 13% decline. That trading halt is also 15 minutes. Both the 7 and 13% halts can take place anytime in the trading day up until 3:25 Eastern Time. After the halt, trading resumes. And if the S&P 500 decline reaches 20% in a single trading day, the halts take effect and no trading occurs for the remainder of that day. As I mentioned at the start, these new breakers went into effect in April 2013. The previous level for halts to occur were declines of 10, 20, and 30% in a single day, with the underlying index being the Dow Jones Industrials. But now those halts kick in at 7, 13, and 20% declines. By the way, there are no upside circuit breakers. What a day it would be if we can only dream about days like that. Thanks for joining me on today's Industry Happenings.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Henry Schwartz, founder and president of Trade Alert. Henry, thanks for joining us today.
Happy to be here, Joe.
Trade Alert, Henry. I know you started this business a while back. Before we get into exactly what Trade Alert is, why don't you tell our listeners about your journey in this industry?
Sure. I don't feel that old, but when I look at
you don't look that old. Come on now.
Well, thank you. I've been doing this for 20-something years. I started on the CBO floor in 1987 as a summer internship for Blair Hull and his very small company at the time. I was a runner.
1987.
87, summer of 87.
So, well, you get a couple months of an upmarket.
Exactly. And, I was clueless. They basically told me, run out to this pit, find this guy in a blue jacket, grab his tickets, bring it back to this person, and do it again.
Kind of just the way things work now.
Yeah, except it's electrons instead of humans. But it was an amazing place to start. The CBO, what attracted me to the business was the kind of insanity of the floor. Just all those people screaming and. It was just such an alive kind of place.
And certainly, 87, the industry was obviously far, far smaller and far, far different, which we'll get to. But it really was a heck of a time to be in the business, in 86, 87, 88.
Oh, it was. Every pit, every single crowd on the CBO was jammed. OEX had, maybe 400, 500 people in it.
Yep.
Technology was just starting to kind of creep in. That was, the Hull's whole model was really starting to apply some computerized systems to what, up until that point had been, guys, that in their head could, price, puts and calls versus each other versus the stock and make, reasonable markets. But reasonable back then was, 50 cents wide. And, besides the human element that I really liked, the technology also was a big draw for me. This was, 87 computers were things like, the Apple II Plus and, big old IBM PCs. And, Hull had stacks of those, way before, there were stacks of those.
Yes.
So that was another reason that, I really was just kind of drawn to the industry.
And then as you progressed off of the floor, I think maybe with a bank for a while?
I did. So from a few years on the CBO and then even on the Amex in New York, which was still a floor, I moved over to Europe for Hull to run their electronic option trading on the DTB, the Deutsche Terminbörse in Frankfurt, which later became the Eurex. And that was really very, very early electronic trading. And that was kind of like, that was such a wild west that you could see things on the screen and you had several minutes to go and check the value against, whatever, system you were using. And the trade just stayed there waiting for you.
And the time frame, was that early 90s?
This was
mid-90s?
This was a 92.
Okay.
So
Yep.
I did 2 years in Frankfurt. Did a year in Paris on the Monep floor, which was actually the first place to kind of try a hybrid system. Basically, there were still a bunch of French guys standing in the crowd, but there was also electronic access from off floor, and that was really interesting. It was a beautiful place to work. But what was very interesting was that was the first place that I could see how the floor couldn't compete with the electronic market. You'd see a price bing on the screen, which was a customer order. And before you could say a word, of course, somebody, an electronic trader from upstairs would hit that trade out. And that was one of the last couple of years of that floor. Then I came back to New York, took a job at Solomon Brothers trading indexes, SPX primarily, still a very physically traded product. Went to 2 more banks, and then after running electronic market making at Bank of America, I started Trade Alert with a developer that I had worked with at 2 of the banks I'd been at.
So listeners, this is why we have Profiles and Perspectives, to give you an opportunity to get to meet folks like Henry with this vast
depth of experience around the world. And so, Henry, tell us, after those years of different experiences all over the place, your motivation to start Trade Alert and what you could see in your mind as an opportunity. Tell our listeners about that.
Sure. So the last kind of thing I was doing at Bank of America after actually running market making was relatively simple customer facilitation, meaning institutional clients would call and say, hey, I want to buy 10,000 of these calls. We'd get them the right price. We'd handle the execution. What was interesting was, the ISE launched in 2000, and the landscape changed from 4 exchanges to 5, and to the fragmentation really picked up, and the ISE was electronic and anonymous, and it became much harder to kind of keep a handle on what was going on. And as a trader, you're answering to salespeople who are not just giving you orders, but they're asking you what's going on. And I needed to have an intelligent answer to what was going on, but the flow was starting to fragment and become electronic, and basically there weren't brokers you could call on the floor anymore and say, hey, what just traded in IBM? In the olden days, you could call, the broker in the CBOE IBM pit, because that's really where everything traded.
And don't forget the Philex. Come on
now.
Yeah,
and the Philly once it was multi-listed. And the broker in there would say, oh, yeah, Goldman just came in and they bought 4,000 straddles and, they're bid for more. And, with fragmentation and automation, there's nobody to call anymore. So, Trade Alert basically was to answer this need for figuring out what was trading when it was fragmented, it was electronic. The algorithms were starting to come into play, so things might be broken up over the course of a day. And I teamed up with this developer, and we came up with a system to basically help all the people that do what I used to do to know what was happening, in their area of responsibility.
So Trade Alert, basically, your business is for both primarily institutional clients, but then you do have some retail offerings as well. Is that
exactly.
Fair to say?
So we started out, definitely on the sell side. The places I used to work, went right back to the desks that I used to be on, and luckily all the people I had worked with over the years had kind of filtered out into other places. Here's an important piece of advice for any young listeners as you start your professional career. It really matters the relationships you start to make, because 15 years down the road, people that you worked with someplace, you're going to run into them again. And what I was able to take advantage of was this kind of incredible network that got me into every big bank very easily, because I could call a friend of mine that worked at Barclays or a friend of mine that worked at Merrill and say, hey, I'm working on something, will you take a look? So our user base is still primarily sell-side traders and salespeople. Those are the people that absolutely have to know what's going on. So it's usually a pretty easy sale because there's not really anything else out there that's designed specifically for that purpose. You can make a pretty decent attempt at getting a handle on order flow using a Bloomberg terminal or something else, but it's really all we do. So that we do pretty well. But what's interesting, is more, over the last couple of years. This was, so we've been at this for 8 years now. Over the last couple of years, we really are getting more retail interest. And I'll tell you, we price our tool at an institutional price. It's $450 a month. I can't believe a retail trader is gonna, even consider paying something like that. But surprisingly, I think that what's really happening is you're starting to get a little bit of a blend of, what's a prop shop and what's a retail trader, and we can discount for retail because I really feel like we should. And so now our user base is really, or whatever you want to call it, has been picking up. And so, we're really basically trying to put more work into serving that audience because, we didn't realize it was there, but it is there.
Interesting. Excuse me, Andy Nybo from the TAB Group came out with a recent report talking about the retail investor is back in the marketplace. And one of the things he sees, to your point, is an increased sophistication level on the part of retail investors. So, the industry seems to be going that way.
Well, it's definitely going that way, and I think that the technology the tools that you get by opening up, a brokerage account nowadays at one of the leading electronic brokers, or any broker that's really decent at options, and most of them are at this point. You get some pretty amazing tools that do make it easy to trade options and to understand what you're doing.
It's absolutely remarkable. I mean, when I think of all the years I spent on the trading floor and had nothing like, as you say.
Yeah, we would spend, at Hull, in the 80s, late 80s and early 90s, we spent millions of dollars building things that you now get for free if you open up a paper trading account.
Yeah.
And I look at these tools and I'm like, man, oh man, this is exactly what you're saying. I would have killed for this. And there's stuff now that there really are retail tools now that are better than what some of the banks are using. Because keep in mind, the banks are kind of stuck with what they have. A bank desk cannot open up a paper trading account at one of these really leading edge e-brokers. They have to go build it themselves, and that's they got to build it in house, and they're only building it for a team of 30 or 40 people. So it doesn't really come out as good as what you get with something one of these leading shops.
Well, how about you talked about Trade Alert being around for 8 years, and the evolution of technology is by and large, and the innovation is why this industry is growing so rapidly. What would you say are really the biggest changes that you've seen over the last 8 years or so? And then maybe we'll talk about what you see going forward.
Sure. The complex order books is really a very big deal. And they're not.
And by that, I mean just for maybe some listeners who may not be sure just what that is.
Well, it's so you used to a lot of option trading, especially as you get more sophisticated. Is in the form of spreads rather than just buying a call or just buying a put. You buy a vertical call spread or you buy a diagonal, or you roll a long call into into another term, and it's all traded in the form of spreads because that gets you a much better price than if you legged it or something like that. The electronic exchanges have come up with these basically matching engines for complex orders. So for spreads, so if I want to buy the June 50-60 call spread and I want to pay $1 for it, rather than trying to figure out where the 50s are and where the 60s are, and okay, I'll pay $2.50 and sell $1.50, you can just put the order in as a spread. There's absolutely no chance that you're gonna execute one leg and not the other. And what's really an amazing advance is that somebody on the other side of it can say, oh, this guy's bidding for this this call spread, I'm going to sell it. Initially those were very separate order books. The CBOE had one, the ICE had one, but what was kind of weird was, and it resulted in a lot of frustration, was you could be bidding $1 for this call spread. It's possible even the individual legs would line up at $1, and you wouldn't get a fill. That's finally being solved in this, I believe the ISE calls it a implied order functionality. So they'll actually, if one leg is offered at $3.50, they'll go ahead and bid $2.50 as part of your order and guarantee, they've actually changed their whole matching engine so that there's absolutely no chance that, you only get filled on one side. So all of a sudden, that's a big step forward in terms of being able to trade a spread seamlessly and get the right price. There's still a lot of ground to cover. The exchanges that have these complex order books are the books are starting to be integrated in the regular limit order books, but there's still no communication from one complex order book to the other. And now you have I believe 5 of them out of all the 12 exchanges. But there's some smart brokers that are starting to kind of bridge that gap. It's a big deal to be able to kind of efficiently and easily trade a spread at the nice low commission rates that you get through the electronic brokerage side.
Indeed. Additionally, the environment overall for the retail investor and really for pros as well. It seems. How would you categorize it? I mean, it seems like
it's never been better to be a customer. I mean, I think everybody will admit that. Including market makers who are kind of on the losing end of that equation. In the olden days, customers were, and the olden days are 15 years ago. Customers had to pay pretty heavy commissions compared to stock commissions. The markets were pretty wide, and there was a decent chance of kind of trades moving away from you, just not getting a great fill, especially depending on what you were trying to trade. Nowadays the competition between exchanges and then between participants, means you can trade for almost, minimal spread, especially if you're in the liquid products, and the commissions have never been lower. And so it's absolutely never been a better time to be a customer. It's easy. It's so easy to trade. I mean, you get a great tool from a broker. You have a very easy time finding the options you want to trade. You have a very easy time seeing things in the the kind of context that that is helpful, and then you just click and buy it, and it's all done. And then because spreads are so thin, you can get out. So it's
a big part of the equation. That
is. I mean, it's. I would say it's still not easy to make money, but it's not as the deck is not. I think it's a pretty fair situation. Mm-hmm. So it's awesome. I mean, I still trade plenty myself, and it's a great environment to trade in as a customer. And on the flip side, market makers and liquidity providers and the big banks, they're doing what they have to do to compete, and they're still able to make a living. So I just think that it's things are about as level as they're going to be in terms of the playing field.
Before we wrap, on the challenges side, do you see particular challenges for the industry going forward?
There's a few things that I don't like. The concentration of volume and liquidity is really pretty extreme. You got almost 4,000 listed products, but only about 400 of them are tradable. Like, it's really, that I think is unfortunate. If you stick with Apple and Qs and Twitter and things like that, you can trade all day. But as soon as you want to go out to something that's kind of thin, the markets are not very good.
They're wider bid offer spreads.
They're wider, and and customers have to be really cognizant of that. It adds a lot of risk to a lot of cost to trying to put on a trade. And I wish that kind of the exchanges would come up with some ways to kind of help boost, pull some liquidity back into those poor products. And I think actually there are, the ISC added PMM offerings for the things that don't trade very much to try to pull some, and then PMMs have an interest in trying to get some volume to trade. So the concentration is tricky, and the weeklies that are incredibly successful have added a lot of contract volume to the market, but I think they've also pulled a lot of liquidity away from the 6-month, 1-year options, because everybody just wants to trade the weeklies. And I guess I would like to see it be a little bit more rounded out in terms of most things should be reasonably easy to trade, not just the top 100 names.
Yep. So. Well, Henry, it's great for you to take your time and join our show here. Give our listeners an opportunity to hear about your experiences and offer some of your expertise. If folks want to, how's the best way to find Trade Alert?
Well, so just go to tradealert.com online. We're very easy to find. We tweet under Option Alert, and we have Facebook and LinkedIn pages as well. But just go to tradealert.com. You'll see our site and our what we've done to kind of address the retail audience in a better way is right there. I mean, we're all about clarifying market activity and helping people make decisions in terms of what they want to do. So that's how you can get us.
Fantastic. Well, Henry, thanks again, and we'll look forward to talking to you again in the future.
Okay, thank you.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is an instructor at the CBOE Options Institute, Peter Lusk. Peter, thanks so much for making time and joining us today.
Hello there, Joe. Thanks for inviting me.
Always good to talk to you. And, before we get into today's strategy, how are you doing, and how are things over at the CBOE Options Institute?
Oh, everything's going really well over here. We had some record volume in October. We're averaging about 7 million contracts a day, which is just super. It just talks to the fact that so many people are getting into options trading, So we're doing really well over here, and education is the key.
Fantastic. Well, you and your team over there really do a wonderful job. And, in addition to all the educational initiatives your gang pursue, adding a little volatility to the markets doesn't hurt either.
No, we love it.
All right. Well, I know you wanted to talk about the covered call strategy. Shall we start by having you explain to our listeners exactly what covered calls are?
Yeah, sure. And, being an educator, this is actually one of the first strategies we like to teach because typically folks that get involved with options trading, they already are familiar with the stock market. They may even have some stock holdings perhaps. And so what the covered call is really all about is, Joe, you've got a stock, you've been watching it for a while, but it's got somewhat of a narrow range. And the plan is to generate some income on a stock that really isn't. So let's say you've got a stock that's trading about $50 a share. And like me, you're probably watching the stock daily or weekly. You're looking at it, and it's like, oh, man, it's 51. Now it's 49. It's back to 50, 50 and a quarter. It just has this narrow range, and it's kind of hit a ceiling. So our plan is to, once again, generate some income on the stock that really is not doing much for us. And so the plan would be to actually sell an out-of-the-money call option in hopes that it goes out worthless. But, keep in mind, when we sell an option, we've got an obligation. And in this case, when I sell a call option, I have the obligation to perhaps sell shares of stock. So when I choose this call in hopes that it goes out worthless, I'm also choosing a target sale price for my stock. So let's just say that the stock's trading 50. I may sell the 52.5, or if there's enough volatility, I may even sell a 55 strike. And it's interesting that you brought up volatility a few moments ago because that's kind of the key in choosing an option. We want enough volatility in the option where there's enough premium to sell. And look at it this way: if there's a lot of volatility in an option, we can expect some significant movement in the underlying, maybe. So go ahead and take a look at some of those stocks that have a lot of high volatility, like a Netflix or a Alibaba and so forth. Those options are pricey, and they're pricey for a reason. So in those stocks, probably not always a good candidate because we get our fangs out because we're all delighted to possibly reel in some really good premium, but we're going to be expecting some big-time movement, and that's probably not the stock that's going to be the best candidate. So we want to have a stock that has some volatility and some volatility in those options. We call that implied volatility, so that we're harvesting some sort of premium. And the plan is to actually harvest it on a monthly basis. So that's pretty much where I'd start out by explaining it, Joe.
All right. Well, that's you actually covered a heck of a lot there, Pete. So really the primary motivation behind these covered calls is to generate income.
You bet. That's the plan.
And as far as picking the stocks, do you suggest investors do covered calls on those companies that they're most familiar with, or should they go out and, now you mentioned a couple real high volatility stocks that move an awful lot, or should they go and look for stocks that maybe they're not so familiar with but have, decent premiums? How do you approach that?
That's a great question. I think the approach can be both ways. I mean, right away, if you already own a stock, you've already followed it, you're familiar with the behavior of that stock. If that stock is not a good candidate, what I mean by that is that when you're looking for the options to sell, let's just say the option to sell that's out of the money is 30 cents. We're talking low volatility and probably not worth your while to sell an option against that stock. So it's perfectly okay to talk to others that trade, or to do the research yourself and just start looking at some stocks that interest you and look at some of the prices. Look at some of the prices out there. Maybe I'm looking to sell a monthly option that's $1.20 perhaps, or $1.75. Now we're talking a little bit more volatility, but not so much that's expressing significant movement. So either way, yeah, if you've already got stocks that you're looking at, but the return is not going to be that good, yeah, there's no problem in digging a little bit and doing some research. Matter of fact, I think the big takeaway today is also go ahead and look at some of the stocks that you do follow and look at some of the out-of-the-money calls and see how they're priced.
And how about at-the-money calls versus out-of-the-money calls? I mean, what goes into deciding? Is there something outside of price that goes into deciding which strike to sell?
For me, it's all about not only just trying to harvest the premium, but targeting a sale price. So I'm more of an out-of-the-money kind of guy where I'm looking for an out-of-the-money option and trying to turn it into a monthly business. So each month I'm going to try to go out there and sell a monthly option, a monthly out-of-the-money option. That's pretty much my intent.
Okay. And how about weeklies? I mean, is this a strategy that investors might consider using weekly options?
Yeah, I'm really glad you brought that up because, before we talk, that was one thing I did want to talk about is weeklies. Great comment, Joe, because here's the deal. If I go out each week, first of all, these weeklies come out on a Thursday and they expire the following Friday. They've got the exact same characteristics as these monthly options that I'm trying to grab. But guess what? These out-of-the-money options that expire in a week, we're trying to take advantage of that accelerated time decay as expiration approaches. Even though some of these out-of-the-monies might be more of a linear rate of decay, we're still talking about that last week. The last life of that option is that last week, and just trying to take advantage of that time decay. So the point is this. Sure, I could go out and I could sell a monthly option for $1.20. Or I could go each week and perhaps on average maybe sell each weekly option for 50 or 55 cents. Let's just keep it clean at 50. If I sell 4 weekly options, in other words, going out each week and sell each one for 50 cents, 50 times 4 is 2. So that's $2 as opposed to $1.20. So every time by going out and selling those weekly options, they're going to certainly outperform the sale of that monthly option because you're taking advantage of that time decay, that last week, the last life of the option.
Now, when you put on these covered call positions, are you managing that short call, especially with the weeklies? I mean, they expire so quickly in the course of 7 days. Do you manage if the stock goes up too fast?
Yeah, another great question, Joe. Weeklies are certainly suited for short-term strategies, and just like the covered call here, and I'd much rather probably sell an option than buy an option, but there's reasons to buy weeklies as well. But the plan, once again, is if the stock is going against you and you don't want the stock called away, you can certainly buy that weekly option back in. And look, if a few days goes by, maybe that 50-cent option now, even with the stock going higher, maybe is still 50 cents or maybe 40 cents. So you're playing the fate of the time decay element against the delta element, which is the movement of the underlying. So it still might not be much of a loser. It might even be a break even, but you could certainly buy that weekly back in, maybe hold your breath and just call it a day on that trade, or maybe at this point go up a little bit higher and sell another option with a higher strike price, be it a weekly or back to the monthlies even.
Okay, good idea. That potential to roll that initial position. Now, how about I mean, the cover call strategy is clearly very popular. What are the risks? Why not do covered calls?
Yeah, there's always going to be risk. The risk is going to be in the ownership of the stock. But the way that I like to look at that is you already had that stock anyway. If you already were a stock owner, and if you were talking about searching for another stock to do a covered call, well, same thing. The risk is going to be in the ownership of the stock, but the premium collected is going to be a little bit of a buffer on the downside. So if you have a stock at 50 and you sell a call for 2, your break even on the downside is now the stock price of 50 less the $2 premium that you collected. So your break even now is 48. And so there's the risk. You could have significant losses from 48 down to, perhaps 0. We've seen it, but not often. But so the risk is going to be in the downside performance of the stock.
Okay, well, that's good to know. So the price of the stock is buffered by the amount of the premium taken in with the covered call.
Exactly.
Okay. Again, is there any reason, why an investor shouldn't do a covered call? I mean, if you're getting downside protection, you're collecting money, why not?
Yeah, why not exactly? Well, sometimes I've heard is that if stock was gifted to someone, and gee, my grandmother gave me this a long time ago, and boy, I'd hate to lose this stock. Maybe there's a sentimental reason maybe not to do it, but you can always keep in mind that you can always buy that option back in so that you don't get that assignment. You don't get that risk of being assigned. You have to sell your shares. And once again, because you're collecting premium, you do have that obligation to potentially sell those shares of stock. But I'm with you. I mean, why not just try to generate some income?
Well, you raised an important point, I think. You mentioned this whole idea of assignment. How can an investor who has sold an option, control not being assigned? How do they know when they may get assigned?
Well, usually you're going to get assigned when it's closer to expiration, and quite possibly there's no more time premium left in the option. And you might also get assigned when we're approaching an ex-dividend date where the call buyer perhaps wants to capture that dividend, and so the call buyer is going to exercise his or her right to purchase shares, which leaves you on the opposite side of that trade to actually sell shares. And the call buyer, of course, would achieve his goal or her goal of getting the dividend. And, of course, if you being called away with the stock that you owned, you would not be participating in the receiving end of that dividend payment.
Okay, but in your explanation there, and they were crystal clear, it sounds like the option seller should have a pretty good sense when they are going to get assigned. Is that right?
Yeah, they should, but also though, Joe, a lot of new option traders, sometimes they're so focused on the trade that they tend to forget about a dividend-paying stock, or they tend to forget that earnings are coming out. Just little things that I actually put on my paper calendar, and you can chuckle at that. I don't have any electronic calendars like most people today, but my old at-a-glance calendar works, so I like to have all that out there in advance of any trade that I make.
So, Peter, is it fair to say that the sellers of the calls have a pretty good idea when they're going to get assigned?
Yeah, they should have a pretty good idea, Joe, but they've also, got to keep in mind that they can get assigned at any time during the life of that contract. And that assignment means a risk of actually selling their shares of stock. And perhaps with a dividend getting ready to be paid out, you can probably expect that a call buyer is going to want to capture that dividend and exercise their right to buy those shares of stock. And also another clue when you can possibly be assigned is when we approach expiration, when there's very little or no time value left in that option. So those are two clues, but an options trader should always keep track of those very important dates. The ex-dividend date as well as an earnings date is very important.
Good advice. So we've got covered calls, we've got income generation, we've got a little bit of downside protection, from the original price of our underlying. Sounds like a darn good strategy for investors who aren't currently using covered calls to consider.
Yeah, I believe that's really true, Joe, and it's just a good beginner strategy to start out with. It just gets you started into dabbling into the options world, which of course can be very fun. There's a learning curve, but it can be very rewarding as well.
And then on the obligation side, as a seller of options, you just have to be prepared, as you've suggested, to potentially have to sell the stock at the strike that you've sold.
Exactly. But as a seller, you can always keep this in mind, is if the trade is not going the way that you would like to, or you don't want to lose the shares, you can always buy that option back in, maybe for a little profit, maybe for a break even, or maybe for a little bit of a loss.
So, Peter, before we wrap, any other comments you'd like to just mention with regards to the cover call strategy?
Yeah, for a new options trader, they've got to keep in mind that they do not have to wait until expiration to close out a trade. They can close out that trade at any time And the reason that they may want to close out the trade is maybe quite possibly they don't want to lose their shares of that stock.
Okay, two very important points. It's been fun, Peter. Covered call strategy sounds like a good one that investors who aren't considering right now may want to consider.
That's great, Joe. I appreciate it. And let's pick another strategy, and we'll do it again soon.
I hope so, Peter. Thanks so much.
Thank you.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we're going to take a look at one of Wall Street's classic sayings, climbing the wall of worry. For those of you new to Wall Street lingo, climbing the wall of worry refers to the market's ability to continue to rise in the face of adversity. That adversity can come in many forms, such as Federal Reserve policies, overall earnings, trends, and interest rate movements. Negative factors can also come from geopolitical climate, both in the U.S. and around the world, market valuations, growth expectations or lack thereof, market sentiment, and on a shorter-term basis, too many short positions being held by traders can all play into the market's ability to overcome real or perceived negative news and continue to rally in the face of adversity. Many of us know that the market bottomed in March of 2009. We're 6+ years into this current bull run, and goodness knows we've been climbing this wall of worry most of these 6+ years. Now, how about if we put a little historical perspective on this current market? A market some are calling a secular bull, and a market that continues to climb the wall of worry. According to Advisor Perspectives, we've had 4 inflation-adjusted secular bull markets dating back to 1871. Now, if you started 1871, let's call that bull number 1. That secular bull ran until 1906, or 29 years, with a gain of about 330%. Bull number 2 is a market many of us know a little bit about. That's the Roaring '20s market that started in 1921 and ended abruptly in 1929. 8 years and an almost 400% gain later. Now, the market bottomed some years after World War II in 1949 and ran higher all the way to 1968, 19 years with a gain of just over 400%, defining secular bull number 3. Another market many investors remember well is secular bull market number 4, 1982 to the year 2000, 18 years of remarkable 660% gain, complete with a 23% dive, Monday, October 19th, 1987. Which brings us to our current bull. Could this be secular bull market number 5? March of 2009 to today, as we noted before, has been a 6-year plus run with a gain of over 300% already. If we dissect this recent 6-year bull move a little more closely by looking at the S&P 500 index, we see the index has had 9 corrections, over 3% since March of 2009. The last time we had a correction of 10% or greater was the summer of 2011, when the U.S. lost its AAA credit rating. The 7 corrections since 2011 have, with one minor exception, all been shallower pullbacks, albeit more frequent since the fourth quarter of 2014. So to wrap up this mini history lesson in today's Looking Back, markets have climbed walls of worry forever. These walls are part of the psychology of the market. The average length of the 4 secular bulls we discussed is over 18 years. Can you imagine if this bull market has another 12 years to run? On that note, thanks for joining me today on today's Looking Back.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/The Options Insider, or via questions@theoptionsinsider.com.